Hey guys, John.Hunter, your mortgage hunter, coming back to you again with another weekly rate update. This one for September 20th. So, hey, this week I'm going to do it a little different, right? I'm going to answer a question that I've been getting a lot in the last 48 hours, and that is what happened with rates since the rates were cut by the Fed on Wednesday. So I'm going to answer that question at the end. So stick around for that because it's not as intuitive as you would think. So a little counterintuitive, as they say. So the Fed delivered on their rate cut this week with a plus size cut on the high end of what the market was guessing, the 0.5 that I've been predicting for a while. It's the first cut since 2020. So, the rates ended the week sharply unchanged. So the 30-year fixed is around 5.75 to 6.625, 15-year 5.5 to about 6.125. FHA 5.75 to about 6.5, VA 6.625 to about 6.5, and down payment assistance 5.875 to about 7.25. Now remember, guys, like I always say, this is based on loan amount, loan type, credit score, property type, whether you're a first-time home buyer, what your income is, the area that you buy in. There's so many variables to these rates that it's kind of hard to compare. Even if you have somebody who's similar to you in a lot of ways, they may get a different rate than you, sometimes higher, sometimes lower. So getting individualized quote is super important when looking at these scenarios. So these are just kind of guidelines giving you a trend over time. So the trend is down overall. It's just not always in a straight line, and we're going to experience that a little bit here. So let me dive into that a little bit. The Fed cut 0.5% this week, right? And the guess was between 1/4 and 1/2. And really, it was a non-event. And here's why. When the Fed starts foreshadowing and laying out the expectations for a rate cut, which been going on for a long time, right? But it really became clear after the July meeting that the mix between the inflation and employment mandates that the Fed has were relatively balanced, and the Fed was basically all but saying, hey, we are going to cut in September, right? And we plan on cutting X amount before the end of the year, and we're cutting in September. So then the guess was, well, was it 1/4? Was it 1/2? Well, realize when the Fed starts saying that they're going to do it, the market is market driven, right? So it's not based on what the Fed does. So what ends up happening is the market reacts to it right away. So rates improved at the end of July and beginning of August because they were building in the cut 30 days ago or more than 30 days ago, 45 days ago. They were building in the cut that just occurred. So the pricing improved weeks and weeks ago. So when the Fed actually meets and does what the market expects, it's a non-event, right? The only time a Fed meeting will ever move the market in a significant way is when they do something that the market doesn't expect or doesn't like. So sometimes I've actually seen situations where the Fed raised rates and then the rates got better. And it's because the market thought the Fed was overreacting and they were going to hurt the economy. And because of that, they lowered the rates. And I've seen it go the other way, where Fed will cut rates and we'll see rates go up. And sometimes that is because the market doesn't agree with what the Fed did. They thought they were maybe overreacting. So, and that's actually kind of case in point this week. So when the Fed, it was like this toss up. Are they going to do 1/4? Are they going to do 1/2, right? If you've listened to some of my other updates, you've heard me just harp on this employment issue for a better part of a year, really. I've been harking on that employment is going to be the driver of when they cut rates, right? That's exactly what happened. So fast forward to this week, when they actually cut the rates, right? The next day we saw unemployment numbers actually come out better, fewer unemployment applications than before. So part of the market was thinking, well, maybe the Fed overreacted. Maybe 1/4% was actually what was called for, not 1/2, right? So we actually saw the Dow on the day they cut their rates. It was like this muted response, and then it shot up a few hundred points and then immediately reversed course and closed down 100 for the day. So it was very volatile because the market is basically psychotic and it's super emotional, and they couldn't find a direction and they weren't sure, right? And that's actually what we've seen this week. We actually saw a little hedging their bets at the beginning of the week. Rates weren't as good as they were probably at the end of last week. Now we've seen that kind of work its way out by the end of this week, but now they're in this wait and see mode on what's next on the employment front, right? Because the Fed has a dual mandate, right? And their mandate is low inflation, maximum employment, right? The inflation has been clearly dropping this year and been steadily going down, but the employment is relatively high. That's actually not normal. Usually in a market like this where inflation is tempering, and the economy is slowing down, typically employment slows down with it. We haven't really seen that, right? But if you've been listening to anything that I've said over the last better part of a year, you'll also realize that I'm a believer that those numbers are absolutely baked, and the Department of Labor statistics is full of it. And that's why there's a disconnect here, honestly, I believe. So I think we're going to see that shake out here, but we're going to see this little bit of volatility with the market really paying attention to the upcoming reports. That's what's going to drive rates going forward, right? The rate cut was built in 30 days ago. The Fed finally did it, and now they're going to be looking for the next cut, which is in November. Now, the Fed predicted a full 1% cut before the end of the year. They just did a half, and there's 2 meetings left. So all else, unless they change their tune again, we expect a 0.25% cut in November and a 0.25% cut in December. Now realize they're going to cut a ton next year, right? There's like 8 meetings a year, and they're going to cut probably 6 out of the 8 meetings, and that's already predicted. So now it's not built into the price yet, but it will be. Now, what I hear all the time, and the question that I get is, why didn't the rates drop when the Fed did it? Well, I just talked about that, where it's built in prior. Now, that's not always 100% true with every type of loan. Now, realize if you have a line of credit or a credit card or a car payment, a lot of those loan types are based on prime, right? Now, the Fed only controls what's called the Fed funds rate. And the Fed funds rate is the rate the banks charge each other for overnight loans, or the banks get charged for overnight loans from the Fed. That's it. Right? So the cost of that using the Fed system, which all the banks have to, is driven by that. So the banks base their prime rate off of the Fed funds rate. So as the Fed funds rate comes down a half, so does prime. So if you have a credit card, you have a line of credit, expect your rate to go down. Now the banks will all react to it in the next couple weeks. I've heard some have already announced it, very few. Most of them are going to make the change as of October 1st, and they'll make that adjustment. So when you hear on the news hey, everything's getting cheaper, the Fed just did this, it's not mortgages, right? Mortgages are ahead of the game. They already are there, right? It's credit cards, loan, like home equity lines of credit, things like that. They're all based on prime, will react to what the Fed does, right? Anything that is more market driven, like mortgages, are reacting way ahead of the time. They're hedging their bets, right? Nobody wants to be last to the party. So that's what we're seeing here. And we're going to see that going forward. So mortgage rates are going to react to the data as it comes out and as the market expects. So next week, now that goes to my prediction for the coming week or so. One of the things that I found really interesting is Jerome Powell gave a very specific number after the meeting, right? Oh, that's the other part. What drives the rates isn't what the Fed does typically during a meeting, it's what they say, right? Which is consistent with what I'm saying, because they're predicting the next move, right? This week's comments that came along with the Fed announcement really gave us no insight on that. The verbiage was relatively the same, the risks are balanced, whatever. They didn't change anything, so the market didn't really react to that. So they're looking for direction, right? So that's what we're going to be looking for after. Now, Jerome did a talk to Congress, I believe, or an announcement afterwards where he did Q&A. And one of the things he mentioned, which is kind of not normal, right? It's kind of out of character, was he mentioned a very specific number. So the PCE, which is the personal consumption expenditure, is their favorite inflation gauge, right? They use that one more than any other. That comes out next Friday, okay? That is for, I believe, August inflation. So the last number we got was for July. July's number was 2.5, right? Now, we don't know what next Friday number is going to be, but Jerome Powell in his speech said that he expects it to be 2.2. That's a significant drop month over month, right? We haven't really seen that. It's actually kind of slowly come down, but not by that much. That's a big percentage drop, really. So what does he know? We don't know. I don't know. He's not really supposed to get those numbers ahead of time, but you know, I don't trust that they don't. But now he's making a prediction. Now he's setting an expectation. So the PCE report, I think next Friday, just got more important, at least in the short term, for what interest rates are going to do. If that number disappoints, if it comes in higher than 2.2, that is going to fuel the fire that says maybe the Fed overreacted. Maybe they acted too soon. Then we could see a short-term spike up in rates, right? But if it comes in lower, it'll feed the fire of, hey, maybe another supersized rate cut is in the cards before the end of the year. That chatter will start, right? Especially if these unemployment numbers actually start to get real and they stop giving Salina bullshit and give us real numbers. I think when those two match, it's definitely going to push the market in thinking the Fed needs to act quicker. And then we could see some larger cuts sooner than later. I don't expect it to be like, oh, here's a point cut, or they're going to get super aggressive and get realistic overnight. That's not going to happen. But it could speed that process up before the end of the year. But the key here is that's what's going to drive rates, right? Remember, what the Fed does is a non-issue if it's what the market expects. So that's kind of where I'm going with this. So pay attention. Next week, obviously, I'm going to be back and give you an update on what's going on with the PCE and what shook out. But it's going to be employment and inflation. If those two continue in the trajectory, the Fed's going to continue in theirs, right? But, you know, this is the real world. It never goes in a straight line, right? So the moral of the story is rates are going down, guys. They are trending down. This is exactly what we've been waiting for. But, you know, no illusions here. It will not be a straight line, right? We're going to see dips and valleys, right? You've all seen the charts for the markets, right? It's never a straight line. It's this jagged mountain looking chart always, right? And those little peaks and valleys are the day to day, week to week, month to month. They're not always going to be straight. So be patient with it. It is headed in the right direction. I think we're all going to come out of this a little bit better when things get cheaper. And as things get cheaper, I think we all can live a better life and maybe buy a new house and refinance, save some money, you know, go on that vacation you've been waiting for, or just be able to buy groceries, right? So, hey guys, I really hope this helped. I hope I answered that question. It's something I've been answering for a lot of people. Some people are disappointed by it because they assumed, you know, somebody flipped a switch and rates just dropped. It just doesn't work that way with mortgages. But hey, you know what? I've been answering that question for better part of 30 years. I don't expect it to go away anytime soon as long as I'm doing this. So, you know what? I'll probably have the same question at the next meeting. So, you know what's funny? I never get that question when rates are going up, right? Nobody ever asks that question. Hey, did rates go up today? No, but they definitely ask it when it goes down. So anyway, that's just human nature, I guess, guys. Hey, one note. Hey, last weekend, if anybody in Washington State watches a little bit of football, so-and-so actually did the smackdown on the Huskies, so go Cougs. And hey, guys, have a wonderful weekend, and I will talk to you soon. Bye-bye.